Okay, folks, tonight we're going to do the second part of accounting. And we're going to start by looking at income and expenses. And the manual covers a lot of the non-profit aspects. So I'm going to concentrate more on a profit-making scenario. So an income statement and expenditure statement is a type of financial document designed to identify all forms of income that is received within a given period, while also documenting all payments or expenditures that were related to that same period. So the income statement is simply another name for profit and loss, and this is a typical non-profitable report, and they clearly put unrestricted and restricted funds separately, so that's easy to identify. Here are a few points to remember when capturing information. One needs to make sure that all sales are recorded. Items which are of a capital nature must not be recorded as an expense. This would be something that has a high value, for instance, machinery, computers, or something like a vehicle that would be used to generate income. These items need to be capitalized and posted to the fixed asset register account, which I'm going to talk you through later. Also, prepaid amounts need to be adjusted for the and expensed over the period that it covers. And a typical example here is workman's compensation. And what happens there is an assessment is completed using historical and budgeted figures to bill the company, and then it's paid in advance. And in large corporations, the insurance premiums are also paid up front, and they use a similar method. Okay, and we'll cover that when we get to the balance sheet. These are the components that make up the income statement, which we looked at briefly last week. We'll have a closer look at them today. And here's a corporate company's income statement, just to give you an idea of the structure. Sales is always on the top, and that's your top line. Then it's followed by the cost of sales. This is the costs relating to the revenue generated. Then you get a GP line. Trading expenses, they are usually categorized differently, and it's usually transport or trade discounts that appear in that line. And then you have an adjusted GP line, which is your profitability after the trading expenses. Then you have the operating expenses. These are normally your fixed overhead charges. And then you report as a profit before exceptional items. Exceptional items, it's mostly relates to importing goods. And then you get your EBITDA, which is earnings before interest, tax, and depreciation and amortization. Then most companies report the depreciation on a separate line. And then you get your EBIT, which is your earnings before interest and taxes. Interest is self-explanatory, and tax always appears last because it's calculated on all the above. And then finally your bottom line, which is your profit. Then you can also add some key performance indicators. It's always good to include these at the bottom. for easy reading rather than having to put them on a different report. Okay, these are your major categories of expenses that appear in the income statement. This is just a guideline as to how you can categorize and group expenses together. Salaries always include your cost to company, motor vehicles, travel and entertainment, advertising and promotion, depreciation, rent and utilities, office miscellaneous, bad debts, IT charges, management fees, interest paid, and then a tax line. Okay, so we're going to have a look at how these invoices, how these costs come to appear on the income statement. So we're going to look at an example of a purchase invoice that's been processed. Here we've had some manuals printed and the cost was 5,000 Rand. The amount, that's the amount before tax. Then you have the VAT and then you have the 5,700. And this is what the entry looks like. You're going to debit stationery with a cost, excluding VAT. VAT is going to go to the balance sheet, to the VAT account, where it becomes a liability to the receiver. And then there's the accounts payable entry. The whole invoice goes onto that line because that's what's going to be due to your company that you purchased it from. And that's where it appears in the income statement. You're going to have a line reflecting the purchase of that particular item. So you notice that there's no VAT in there, and that's assuming the company is registered with VAT and can then claim it back from SARS. And if they are not VAT compliant, then the full amount of the 5,700 would appear there, because you're actually taking a loss, a knock on the VAT if you can't claim it back. And now the person that is capturing the invoice doesn't have to separate all this. They merely capture it and all this good stuff happens in the background. However, they do need to know whether the company is VAT compliant or not. So they need to be aware of whether this can be posted to the relevant VAT account. They also need to know whether the item that was purchased is claimable, because things like refreshments, alcohol, can't be claimed. So in a case like that, the whole expense would go in this line under this category. Okay, let's move on to the next one, and that is the income statement. We had a look at it briefly, but let's look at it in more detail. It reflects the revenues, cost of sales, the expenses, and then it produces a profit and loss. Revenue. It's the income generated by the sale of goods or services relating to the company's primary operations. Having multiple income streams allows a business or individual to have various cash flow resources. This puts the company in a better position to be prepared if one or more sources of income fail. Good business practice is to explore other revenues streams and move away from the danger of having their eggs in one basket. We see how many businesses have started up by just supplying a particular item and then building on it, perhaps selling a part of the particular item, and even perhaps going on to having service or maintenance plans which they can convert into income. It's important to prepare strategies going forward based on these different revenues and estimates, because some are more profitable than others. And that's why it would be reported in its different categories, and then the margins can be measured and you can tell which are your more profitable items and which aren't. So let's have a look at the revenue process. Now this is a stock item, and it's a forklift sale that's been invoiced out. Here we see the revenue, also excluding VAT. That would then go directly to the income statement. The VAT, again, would go to the balance sheet, and this now becomes an account receivable. So someone owes you money here. So what else happens in the background when the inventory moves out? It reduces the balance sheet with the inventory amount, but the stock is reduced by the cost only, because there's a profit margin built in here, because you're not going to sell the item for what you bought it at. Then your revenue is increased. That's the only line that goes to the income statement. The VAT is then increased, and that goes to your balance sheet. And the debtors account is increased also on the balance sheet. Okay, now we're going to have a look at the balance sheet. It provides the investors with the information they require when looking at investing. The balance sheet is a summary of the assets, liabilities, and equity. Now, a common term used to describe a balance sheet to its readers is strong. This indicates that a company is liquid, which means it has enough cash to handle its liabilities. Having a large amount of cash is not only the only determining factor when deciding whether a balance sheet is strong. Many investors use the liquidity ratios to determine the strength of the balance sheet, which is a good indicator of how the business is doing. Another term is light balance sheet. This equals a low debt value and is more likely to attract investors. Fixed assets. Anything a company has purchased for a long-term use and is not likely to be converted into cash, such as land, buildings, plant and equipment, furniture, or computers. These need to be capitalized. We're going to look at how a fixed asset is added to the balance sheet. When it's purchased, it needs to be added to the fixed asset register, which is a subsidiary ledger that is controlled all on its own. And this is what the entry is going to look like. We bought an office desk of 15,000. 2,100 was the VAT, and the total invoice is 17,100. That's what the posting is going to be. It's a debit to the balance sheet. All these items are now on the balance sheet. It's not going to go to the income statement as explained before. These are the items one needs to be careful of, that they don't go through the income statement. And then we're going to have the VAT, and it's an accounts payable entry because it's something that now has to be paid. And that's where it's going to be reflecting on the balance sheet. And as you can see, it's at cost, no VAT. Okay, so what one needs to understand about the balance sheet here is the difference between fixed assets and assets. Fixed assets appear on the balance sheet and are disclosed within the overall assets of the company. So this is your asset, and within it, there's a non-current assets disclosure, which then doesn't make up part of the actual assets. It's completely separate, but yet it falls within this category. I hope I'm explaining it right. Okay, accounts payable or creditors. Let's look at how this stock item is treated. The total of the cost goes to inventory. The VAT, 42,000, goes to the VAT account. And once again, it's going to be an accounts payable entry going, all of this goes to the balance sheet. Okay, then we have the Creditors Age Analysis, and there you'll see the item as a payables. Inventory, so also known as stock, it's the company's products that remain unsold as at month end, and therefore it sits on the balance sheet. One of the pitfalls of having too much inventory is it ties up your cash, and this will have a negative on your cash flow. And here's the entry. When the purchase invoice was captured, the stock automatically went to the inventory at cost, and the effect would be inventory increases on the balance sheet. So we've seen both scenarios where the inventory comes in and where it goes out. The stock is then added at the cost price. Okay, and here we have the accounts receivable side, where we have a forklift that has been sold. The revenue goes to the revenue, VAT and accounts payable, and it sits on the Debtors Age Analysis until it's paid. Debtors Days. These are monitored very closely by management because having cash tied up in these two areas can cripple a company. There's a simple way of calculating debtors days. You need to determine the average debtors balance for a period and divide it by the annual turnover times the amount of days of the year. And there's just a graph showing it's a good way of just presenting debtors days. Okay, so prepayments. When a prepayment is made, the debit entry is made in the expenses, and it's going to be charged over the year that it applies to. So if it is over this financial year, you're going to have this total, say for instance, the amount that was paid as a prepayment. It would have been paid in the beginning of the year, but expensed out over the entire year until it's depleted. And then the prepayment comes up again. And this is an easy transaction to record because most companies have recurring journals to generate these items. Okay, provision for taxation. So it's one of those items that appear on both the income statement and the balance sheet. But here's the balance sheet side, and it's called a provision because as the months go along, you provide for the taxation, and then the payments are made periodically depending on the company's financial year end. Okay, I just wanted to add here that the taxation is very complicated in large corporations, and that's why companies employ tax accountants. Smaller companies, however, can get by with just using tax consultants, but this is a very complicated calculation. And then we have the VAT, which is always payable in the following month, just depending on your arrangement with SARS. But everything sits in the balance sheet until it's paid over or until it's been refunded by SARS. UIF levies, all of these company contributions also just sit in the balance sheet until it's paid over to the respective customers or companies. Bad debt provision, these will appear as a liability in the balance sheet until it's utilized, and you can then just write off bad debts. So the benefit of having a bad debt provision is that if you have to take a knock from a company, it won't be detrimental to the company, because if you've had a provision, you then take it to the balance sheet, where the credit that's lying there would then absorb the debit that you've been knocked with. Petty cash, most companies carry a float which is allocated to an individual who then keeps the money in a petty cash box. Petty cash expenses are paid and are expensed accordingly. So it's the float amount that remains on the balance sheet. Every month when you reimburse or restore the petty cash, you automatically take the debit to the expense that it's made from, and your credit is in the bank account where you've reimbursed the money from. Okay, provisions. Provisions are made using estimate amounts. The debit is made in the expense and the credit entry made in the balance sheet. Accruals, very similar to provisions, but it's not the same, because an accrual is an expense already incurred but not yet paid. The debit will also be made in the expense account, and the credit will be held in the balance sheet until it's paid. Okay, and then the equity calculation that we looked at was the assets equals your liabilities plus your equity, which is the portion of the company that is owned by the investors and owners that also sits on the balance sheet. Okay, so what I wanted to show you here is the balance sheet and the importance of calculating stock as well as debtors days. It can also be included in your monthly reporting. Okay. We had a look at the trial balance, the chart of accounts, which is the list of all the accounts, the trial balance. And this is then the report with the balances in, and then the general ledger. And as you can see, this must always net off to zero to have a trial balance that balances. And so the general ledger is this complete record, the financial transactions. Okay, so what do we do if the trial balance does not balance? And this can happen. This used to be a huge problem back in the day when systems weren't so sophisticated, and the biggest problem was when the system went down due to power failures, and also human error crept in when people were posting errors, and these all resulted in imbalances. But nowadays, we have what we call a suspense account, and the system automatically posts to this account, and you can identify it quickly by just analyzing the suspense account, and then one can do the necessary transactions to correct it. Okay, so that's the end of the balance sheet. I also wanted to say that the balance sheet is a vital document when it comes to audit time. The auditors are fanatic about this. This is one of their first items they ask for. And all these accounts need to be reconciled on a monthly basis. And they actually want proof and evidence of these monthly reconciliations as part of their audit. Okay, the cash flow statements. The purpose of the cash flow is to show the cash flowing in and out of the business. Although this report is included in the month-end financials, it can be done daily, which isn't a bad idea because management can then play an active role in deciding who gets paid when, if cash is tight. And here's our example from our assignment. I'm hoping that everyone's done it. Okay, let's have a look at budgets. Here are some guidelines. Firstly, a budget is simply a spending plan that takes into account both current and future income and expenses. Having a budget keeps you in check and makes sure your savings are on track for the future. A budget helps to figure out your long-term goals and helps you work towards them. It helps ensure that you don't spend money you don't have. It helps lead to a healthy retirement. It helps to prepare for emergencies. Budgeting allows you to rethink your spending habits and refocus your financial goals. Okay. The forms of budget that one can get is your initial budget, which has to be completed at least 6 months before financial year end. And then the plan figures are figures that are then built on the budget and they are reviewed quarterly or revisited quarterly. And they come up with plan 0, 1, 2, and 3. Then strategic planning is a long-term futuristic forecast, which includes figures and is just as important as the budget. It's important to also estimate the revenues accurately. Consider the recent monthly growth rate experienced by the company and decide if it can be continued. Review industry guides and other expert publications that focus on your industry. Discuss the expected sales with your sales department and set expectations to help determine goals. Communicate with your current customers to better understand their expected needs of your product or service. Review financial information from a number of your competitors if available. Operating margins also need to be considered. And here are a few factors to help you identify the or to take into consideration when setting budgets. Inflation, economic climate, be realistic about the future market, monitor your supply and demand, staff increases, public holidays, that means you've got shorter months, and then take into account seasons, fruit seasons, festive seasons, etc., and public holidays. Okay. Then determine your expenses, compare expenses to prior years, and use this time to challenge your employees to identify cost savings related to the delivery of products and service. And this would also be a typical budget plan where you review actuals to your planning figures. Okay, and even in the budget process, the balance sheet is vital, taking into account your stock days and debtors days also need to be budgeted for. Okay, identify capital expenditures. You need to decide where you want to spend money. This includes maintaining current equipment or upgrading existing, depending on the area where you'd like to see growth. The break-even point. This is the point at which total costs and total revenue for a particular venture are equal. At the break-even point, an organization has recouped its costs but not yet made a profit. This term is often used in business, especially regarding sales as well as investments in other areas. So break-even analysis tells you how many units of a product must be sold to cover the fixed and variable costs of production. To be profitable in a business, it's important to know what your break-even point is. Your break-even point is the point at which total revenue equals total cost or expenses. At this point, there is no profit or loss. In other words, you break even. So the aim is to go beyond that point. Management accounting. And, okay. Management or managerial staff depend on accounting information to make decisions and use many forms of reporting to do this, either in written statements. Graphs are always good because the visual is easier to grasp. The oral is also a form of communicating. Managerial accounting involves the presentation of financial information for internal purposes to be used by management in making key decisions. Managerial accounting encompasses many facets of the accounting, including product costing, budgeting, forecasting, and various financial analysis. The daily duties of an accountant, it's generally understood that they take care of the financials, but what does an accountant do on a daily basis? Recording and categorizing expenses and preparing financial reports, analyzing financial data so that they can recommend ways to help the organization run proficiently, conducting a risk analysis evaluation, taking care of tax returns and making sure they are paid in time, examining the accuracy of financial documents and where they stand with laws and regulations, offering advice to organizations on how to reduce costs, improve their revenue, and boost profits, finding and addressing any discrepancies within accounting. The depreciation. So this is the loss of the value in an asset over time. Generally, an asset has to have substantial value in order to warrant depreciating it. Depreciation appears on the income statement as an expense and is often categorized as the non-cash expense since it doesn't have a direct impact on the company's cash flow. And there we have a little graph that shows when you buy a car, it's at its full cost, and then over a period of never 20 years, in less than that, it is not worth much. Okay, so we said we're going to discuss the tangibles and intangibles. Let's see here. Accumulated depreciation is associated then with tangibles. And another method is impairment, and amortization is in the way you depreciate intangible assets. Okay, accumulated depreciation is the term used for intangible assets. That means the ones that you can physically touch, like a machine or car or anything like that. But the amortization is more for licenses, software, patents, etc. And after taking depreciation off the cost of an item, you get the book value. And here's a brief description of the intangibles and tangibles. And that's the end of it. Any questions?